everybody. This is Alan Ellman, the Blue Collar Investor, with today's option selling question of the day. Today's question comes from John, and I've titled this, Should I Close My Very Deep In the Money Covered Call? Alan, I started an in the money covered call trade with VRT, C attached trades, and the stock zoomed up over $60 per share. Can you show me how to calculate if it pays to close this trade and which spreadsheet to use? Thanks for your help, and it's signed, John. Well, John, absolutely, because there are times when the price of a stock after we enter a covered call trade does in fact go to the moon. And we've maxed out our trade. We can't make any more money. So should we close the trade? And we actually do have a specific spreadsheet for that. So let's get started and first have a look at the trades that John shared with me on January 24th, 2025. So the trade started off on 3/14/24, where VRT was purchased at $92 per share. Once those shares were owned, we were then in a covered or protected position, and the 7/18/2025 $90 in the money call was sold at $13. Now notice that I highlighted here in yellow that the expiration date was 7/18/25. Well, that's like 16 months later than when the trade was entered. And we should never really go that far out. We're exposing ourselves to multiple earnings reports, and we're losing the opportunity to reevaluate our bullish assumptions on this underlying security, which we could do 52 times a year if we're doing weeklies, 12 times a year if we're doing monthlies. So we normally don't go that far out, but that's the way the trade was presented. So let's discuss this particular specific situation. So what happens is about 10 months later, on January 24th, 25, VRT had zoomed up to 156.25 from 92. Yikes. And again, there were multiple earnings reports, and if it beats expectations, what's going to happen? The price is going to go up. And that's what happened here. Now, the cost to close, which I'm going to show you in the next screenshot here, was $90. The cost to close the $90 call, rather, was $68.30. So that seems like an awful lot of money. $6,830 per contract. Wow. Why would he spend all that money? Well, the reason that we might spend all that money is that the bulk of that $68.30 is in the form of intrinsic value. And if we buy back the option, the shares will no longer be worth the max possible, which is 92, as long as that option is in place, due to our contractual obligation to sell at 92, but will now be worth current market value of 156.25. So most of that 68.30 is negated by share appreciation, or the intrinsic value component of that premium. And you'll see that coming up when we do the calculations. So what we really want to find out is how much are we spending of time value, because that is in fact what it will cost us, the time value, not the intrinsic value. So here's the option chain that George was alluding to when he said that the cost to buy back that $90 in the money call would be $68.30. And there you have it. You go to the ask column, not the bid column. We sell at the bid, we buy at the ask. So there you have it, $68.30. Now, we do have a spreadsheet for this, and it's actually a worksheet that's part of the BCI Trade Management Calculator. You'll find these tabs at the bottom of the spreadsheets, and you'll just go to the Unwind Now tab, and that's a worksheet tab. It's not actually part of the Trade Management Calculator. It's an additional tab that we added to it. So what do? We put in the information you got from the option chain. Here we go, VRT, trade entered on 3/14/24, expiration 7/18/25. The price was 92, the strike was 90, and actually that's the most it could be worth, $90, until that option is removed. That's our contractual obligation to sell. and the option premium was 13. Okay, now today, 124, the shares had moved up to 156 and a quarter. And the cost to buy back the option was 68.30. Most of that intrinsic value. The date that this was placed was 124.25. Now, once that's entered, the spreadsheet will give us the calculations that will help guide us to determine whether or not it pays to close both legs of the trade. Here we go. Now, this is a screenshot of the spreadsheet after the entries are made. Let's look at the blue hours first. That will tell us when the smoke clears, if we close both legs of the trade, that we will have generated a 9.7% return over 316 days, and that annualizes out to 11%. Okay? Nothing to write home about, but not bad. Let's put it under the heading of not bad. All right? Now, down where you see the red arrow and above it, that's the key part of this spreadsheet. It tells us the following. The actual time value cost to close, taking out the intrinsic value, which is made up by then share appreciation, is 2.28% or $205 per contract. That's the actual time value cost to close. All right. Now, the question we ask ourselves is, by contract expiration, which is still about 6 months out, does it pay to close both legs of the trade? Can we make at least 1% more than 2.28%, which is our actual time value cost to close? So let's analyze. The unrealized return with no exit strategy intervention is decent, 9.7%, 11% annualized. Decent. By closing both legs of the trade, the time value cost to close is what we just stated, 205 per contract, 2.28% from a percentile perspective. Now, there are nearly 6 months remaining until contract expiration, which is 7/18/2025. Can we generate at least 3.28% over those 6 months? And of course, the answer is, for those of you who've been with us for a long time, of course we can. 3% is easy. Unless the market is constantly tumbling against us, we can easily do that. So it does make a lot of sense to consider unwinding and closing both legs of this trade. Let's summarize. Shorter dated options will generate higher annualized returns and allow us to avoid earnings report dates. All right. Also, shorter dated options will allow us to reevaluate our bullish assumptions on our underlying securities. Just makes a lot of sense. Don't be enticed by the huge premiums that you get when you go out 16 months or any longer dated option, because when you annualize it out, it'll almost always be less than the shorter dated. It will always be less. Now, using the Unwind Now tab of the BCI Trade Management Calculator will allow us to calculate the actual time value cost to close. And if we can generate at least 1% more than this, then it makes sense in giving the unwinding of both legs of the trade serious consideration. Now, to master the strategies, you want to take advantage of these low-risk option selling strategies, go to our store at thebluecollarinvestor.com. The best place to go is our best packages, which is our best discounted packages, or build your own toolkit where you get items individually. But under best packages, you can look at our BCI, our main package, an acronym for best and most comprehensive investment package. It includes 6 online video courses, about 2 hours each, and they come with downloadable workbooks, 6 calculator spreadsheets invented by the blue collar investor, and 5 of our best-selling books in ebook format, along with our 13-month premium membership. That's the main perk to this package, where you get the 4 reports of eligible option candidates, along with over 250 training videos and much more. The second of our best discounted packages is our Trade Management Calculator package, TMC. It includes the trade management calculator, spreadsheet, which is a must. It also includes that worksheet we talked about in this particular video, and a PDF version of my 8th book, Exit Strategies for Covered Call Writing and Selling Cash Secured Puts. It's 27 chapters of exit strategy information. The third of our best discounted packages is our CEO package, an acronym for combining exchange traded funds with stock options. It includes 2 spreadsheets, one that will help us set up our portfolios and one to archive our results and compare it to that of the S&P 500. It also includes a PDF version of my 9th book, Covered Call Writing, a Streamlined Approach. It's a great way to take advantage of covered call writing for those with very busy, hectic schedules. Can get all 3 of our packages by going to the CEO package, and then the 3 choices include the CEO total package, which gives you both the BCI, TMC, and CEO packages for the biggest discount, and then you also get a premium membership on an annual basis included in that as well. Can go to our store and just purchase items individually with Build Your Own Toolkit. So there you have it. This is our Ask Alan video. Believe it or not, number 232. John, I want to thank you so much for sharing these trades with me and allowing me to share this information with the entire BCI community. I want to thank you for that. And of course, I want to thank everybody out there for taking the time to view and listen to this Ask Alan video. Folks, I hope you enjoyed my presentation, but most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.